Okay, we're going to talk about timing the market, and just let me say this. This morning has been pretty much like going to basic training in the military. We've given you the fundamentals. We talked about getting started, how to work the graphs, and this is the last major key tool that we're going to use in preparing to really apply VectorVest to make money. It turns out that we now believe that timing the market is the single most important thing you have to know. The single most important thing you need to know is whether the market is going up or going down. Everything follows from that. I never did believe in buy and hold. Just intuitively, I felt, well, I'm not going to sit there. If the company runs into trouble and the price starts going down, I'm not going to sit there and hold my fingers crossed. I always had an exit strategy, even from the very beginning. I didn't realize how important this was until the early 90s. In 1995, we went from a digital database to Windows. And when we went to Windows with VectorVest Pro Graphics, we were able to look at graphics. And one day, I was looking at a graph of the VectorVest composite. We released VectorVest Pro Graphics in January of '95. And it was either February or March of 1995 that I looked at a graph of the VectorVest composite. Now, we had been calculating that data, and VectorVest composite is the average price of all the stocks in the database. Currently, it is now an arithmetic index of the price of all the stocks in the database. But even with just the average price, I looked at that and I said, oh my goodness, this looks exactly like what the market did last year. I was looking at a one-year graph. And that was the beginning of our formal market timing system. Prior to that, I had always used a buy-sell ratio, or the percentage of buys and the percentage of sells. Because in our basic system, if the price of a stock is going up, and if it has reasonable fundamentals, it would get a buy. And if the price is going down below the stop price, it would get a sell. And I had enough sense to know that if you use a 13-week moving average, and more stocks in the market were below the 13-week moving average than were above, you would have a weak market. And if more stocks were above, you'd have a relatively healthy market. So I had been using that as my primary guide, assessing the nature of the market. But when I saw that graphic of the VectorVest composite, it was like, oh wow, I woke up. Let's go to the next slide. In your booklet, you have the key elements of the VectorVest market timing system. Now, I'm going to leave the PowerPoints, but hopefully I will touch on the slides in your book, and we'll start describing what these are from a graphical standpoint, because I think that's the best way to do it. Brian, would you go into graphs? Click over here in stock graph. Click on a market timing graph. Now, this is a default market timing graph that we are currently using. The upper line is the data on the behavior of the VectorVest composite in candlesticks. And Brian, would you just zoom in into the last area there? And it shows the open, high, and low. Of course, in candlesticks, if the market closes at a higher price than it opened, you get what's called a green body. The wick, that straight line that's above and below the body, is the low for the day and a high for the day. If the market closes lower than it opened, zoom in again, Brian. If the market closes lower than it opened, it's a red body. You know, I love candlesticks because it gives you so much more information to just a simple dot. This looks like the market essentially went down all day long. This formation here, where the market closed essentially where it opened, that's called a doji, and this is the interpretation of that is the bulls and the bears had a terrific battle all day long with the standoff at the end of the day. And they say a doji is usually as significant of a turning point in the market. Now, that's not what I came to talk about. I'm going to talk about timing the market and how we got there. You can unzoom, Brian. And Brian, let's look in graph layouts. VectorVest MTI layout, is that what we got right now? Okay. I want to go back to the more historical, traditional layout. Can you change these candlesticks to dots, to points of data? Change type, area line. Change style, okay. And circles. Okay. That's the way the data look in VectorVest 6 and what we were using prior to that. Now, at the bottom, can we put the buy-sell ratio? You have these in area form. And just save the buy-sell, take the MTI off, and the RT. This is more or less the traditional setup for market timing. Let's go to the all data graph. And let's look at the weekly, okay? Let's go to the weekly graph. Go to the end of the week. That's what we had traditionally. And I want to see all the data. And we can turn that off. Now this graph goes all the way back, I believe, to sometime in 1995. And unfortunately, we don't have the graph on here that I saw in March of 1995, where I saw what happened from March of 94 to 95. But basically, the idea is the same. I saw exactly what the market did. Those of you who may remember, in February of 1994, Dr. Greenspan had what he called a preemptive interest rate hike in February of 1994. And it shocked a lot of people because they were playing the interest rate spread on T-bonds and T-bills, and a lot of them got caught with their pants down. You remember towns like Newport in California and a lot of university pension funds got in trouble because everybody was playing this interest rate spread. And all of a sudden, it reversed on him when he raised it. So it caused a lot of pain, and it caused 1994 to be a pretty miserable year as far as the performance of the stock market went. So you could see that dramatically. Nevertheless, what I saw is I thought, well, you know, if we have this VectorVest composite graph, wouldn't it be nice to be able to buy here, sell there, and sell up here, and buy down here? Or even if you're real greedy, you like to buy down there and be able to take this thing all the way up, and maybe you have a little turn there. In other words, buy at the bottoms and sell at the tops. Wouldn't that be nice? Well, I didn't know it was even possible because I had read A Random Walk Down Wall Street, and I had been conditioned to believe you couldn't time the market and all that stuff, even though I looked at the buy-sell ratio. But nevertheless, we had, in our office, we had a young man, a high school student, that worked for us. And prior to ProGraphics, we had all our data in digital form. And prior to the digital form, we were publishing a little blue book. So we had data going back for many years. And I had this young man just take all his little blue books out and plot the data by hand. And he did. He did for several years. And we looked at it and we studied it. And if you would, Brian, just zoom back, go back a little further. That's good. All right. So we studied it, and what we saw, zoom in again from here to back. That's good. What we saw is we saw a phenomenon that surprised me. We saw that if the price of the VectorVest composite, now these are weekly data, if the price goes down 2 consecutive weeks, that it was a pretty good signal of a sustainable downtrend. Okay, you see it here. Okay, you see two consecutive weeks going up, and here you had 2 weeks going down. It went down 3 or 4 weeks, then it went up. Here, right here, zoom in this little area here, Brian. That's good. Here you had a situation where you had your 2 weeks down, and by golly, turned around and went up. And that's a reversal, okay? The thing is, however, these reversals were relatively rare. So we say that's a preliminary signal of a sustainable downtrend. You can unzoom, Brian. And I thought, well, that's interesting, but I need something to confirm it, okay? So let's zoom in on this area here again. Let's get a little closer. That's good, okay? Now, let's take a look at this situation here. I got 2 weeks down, and can you draw a line over that second down line? No, just draw a line. Use a date line, Brian, it's fine. Okay, we got the 2 down weeks, and I thought, well, I've been using the buy-sell ratio for a long time, and by golly, when this thing started going down, the buy-sell ratio started going down, and I said, well, if we see the 2 weeks down and the buy-sell ratio goes below 1, that would be a confirmation of the onset of a sustainable downtrend. And click this, and I want to see the value of that buy-sell ratio there. Okay. The value right there is 1.54. Okay, let's see what it is the following week. It's 1.1. What about the following week? 0.57. Zoom in a little more. That's good. Okay. So actually, what this is saying, we didn't get to confirm down until this thing had gone down 4 weeks. Okay. Now, this date here, take this date here, okay? That point there, the buy-sell ratio was 0.11, very low, and let's see what it was the next week, Brian. It was 0.28, the next week, 0.34, the next week, 0.46, August 30th, the next week. They finally got the confirmed up, okay? And you can see that the confirmed up was relatively slow, all right? And nevertheless, it was a reasonably good signal. We've got better signals than that. Take a look at that one. That was February 28th. The confirmed buy-sell signal was 0.55. We got that in 2 weeks, and this baby went all the way down to here, okay? And look at that point now. Can you stretch that a little more to the right, Brian? That was 0.15, and we had this tremendous up move this week. Go ahead forward. Okay, it's 0.90. Now we see it's 3 weeks in. We finally got the confirmed up. So the confirms up are reasonably reliable, but they tend to be a little bit slow. And what I wanted to do was try to get in as close to the bottom as we could and get out as close to the top as we could. Okay? And that's when we began thinking about, boy, you know, if I see that 1 week up, what is the risk of going in at the end of the week? The irony is, like a lot of things in life, if I want to get in sooner with less information, the risk is higher. And of course, that week over the week data point is what we call the primary wave. But the name of the game from the very beginning was to see how close to the bottom we can get into that move, or how close to the top can we get out of that move, okay? And so we began looking at things. You can unzoom the whole graphic. we began looking at things such as what are some of the clues that we might use to see how we can estimate whether we're approaching a turning point or not. And Brian, put the stop price on here, could you? Okay, now zoom in back into this area here again. Let's zoom in some more. One of the things I began to notice is that if the price is going down and approaches the stop price very closely, the market is quite oversold and the downturn may be ending soon, okay? And move that date line a little bit, a point or two to the left, Brian. Zoom in some more so we can see it better. That's good. All right, there we go. And you see that bottom right there? It's the closest point to the stop price. And that I began using that as an early indicator that we were approaching the bottom. On the other hand, if the price was way above the stop price, we were getting overextended, okay? And same thing here and the same thing there. So that was an indicator. Another thing I began looking at, of course, is if you go to this very bottom here, you see that the buy-sell ratio is 0.15. If you look at the bottom here, the very bottom there, the buy-to-sell ratio was 0.17. Then over time, we began to see that, well, Brian, unzoom altogether. Over time, we began to see that if that buy-sell ratio at the bottom here, okay, take the price off. And stop. Over time, could you draw a line at 0.2? Can you do that? Horizontal line. Boy, that's good. If the price goes below 0.2, you're pretty well at the bottom of the down move. Now, the secret is, just because it's gone below 0.2, you don't decide you're going to buy. You got to wait to see the up move. You got to wait to see the up move. And so if the price had gone below 0.2 and then you had a big up week like we had shown in one of those examples, you know, you can say, well, if you're fairly aggressive, you can jump in there and start buying. So that is a technique that we've used over and over again. The key is you got to see evidence of that up move. Another thing, Brian, put the price back on there again. And let's look at the relationship of price and RT. Let's zoom in this direction. Start here. Let's look at this situation. Brian, can you connect those 2 points? And connect these to the same 2 points on the RT. This is what you call a bullish divergence. What is this date down here? Oh, that's March the 6th. That was a very interesting day because I wrote an essay called Itching to Rally. That's a Friday, okay? And it's one of the things that I saw that caused me to write that essay. Of course, I was watching the behavior on a day-to-day basis of the market, and it seemed like that period of time was just one bad news day after the next. And no matter how bad the news was, the market seemed to want to rebound during the day. And so, of course, I think I had written in that essay this phenomenon about this thing is starting to look exactly to what I saw at the bottom of the market. Unzoom, Brian. And let's go back to this situation right here. And this situation right here. This is exactly the same as what I saw in 2002 and 2003 before this tremendous rally here. And so I began seeing similarities in what was going on. And these are some of the techniques that we use in assessing whether we're nearing a turning point or whether we have seen a valid turning point. But the basic system of 2 consecutive weeks in a given direction, plus the crossover, the buy-sell ratio, remains the same. We look for that as a confirmation. We continue to strive for trying to get in as close to the bottom and getting out as close to the top as we can. And I think over the years, we've done a fairly reasonable job. Brian, pick that point there. I think that is October the 9th of 1998. Yeah, that's right. Now, I think Brian or somebody says you don't have to figure this out all by yourself, okay? Because that's October the 9th, and then the following week, the following Friday is the 16th. Go forward one day. We try to document what we see in the VectorVest views. And I'll give you an illustration here. Go ahead to views and go back to October the 16th of 1998. The title of this overview is "The Worst is Over." And in this essay, I talked about the various things that I was observing about the market. And we suggested that aggressive investors could play the market to the upside. And of course, the market continued on its merry way higher. In March the 21st of 2003, go ahead and find that. Go into the strategy section, Brian. There we go. The monster rally, blah, blah, blah. Therefore, you should take steps to protect your investments. See the strategy below. All investors should be aware of the risk involved. This was a very, very difficult time. Let's see, the price of the composite has risen for 2 consecutive weeks, and the BSR has gone from below 1 to above it. Therefore, we have received a confirmed up signal, okay? Now, I was cautious here. I said, while this is all well and good, and we went long yesterday, I'm concerned about the underlying factors driving this rally. You know, the war in Iraq had started. And here again, it's the war that I thought stimulated this. But nevertheless, we made the call, okay? We went long with a blend of spiders and Qs. All investors should be aware that a catastrophic event could turn this market around. And now, that was the situation that we nailed. We came in very close to the bottom. Brian, go to November the 2nd of 2007. And let's go to the essay part. We got a confirmed down signal on November the 1st, okay? On November the 2nd, I wrote an essay on buying contra ETFs. And what I said here, does a down market mean you can't make money anymore? No, not at all. In fact, it could be easier than ever with the advent of contra ETFs. And so we talked about contra ETFs, and at the bottom of this essay, I wrote a note to new subscribers saying the confirmed down signal that we received yesterday could be the entree to a long bear market. We aren't there yet because earnings are still rising, according to our method of analysis. Yet we no longer appear to have the support of the accommodative Fed that can make things very bad for the stock market. Little did I know how bad it was going to get. I had a feeling it was going to be bad, but nevertheless, we advised our subscribers to be aware of an impending bear market. We suggested they buy contra ETFs, and we made it very clear that this is not the time to buy stocks. Finally, I want to show you the essay we wrote on March the 6th, 2009. This was itching to rally. I talked about this a little bit earlier, the fact that each of the big down days we've seen recently were triggered by something out of Washington. The biggest up day on Friday, the 24th, was caused by Dr. Bernanke's testimony to Congress, which wasn't even factual. I think he was lying to Congress, and it's not the first time a chairman of the Fed has done that. Investors are dying to buy stocks, and any scrap of good news, true or not, will serve the purpose. The market is itching to rally. Well, the following Monday, go into the strategy section, Brian. We had advised our subscribers to be ready to take advantage of any kind of that's good, right there. Be ready for an explosive up market. On Friday, it didn't happen. On Tuesday morning, the 9th, Citigroup announced that they had made money in the first month of the year, okay? That triggered that explosive rally that we were talking about. And these were the stocks that we suggested. These are all bottom fishing strategies. And, you know, you had stocks like Las Vegas Sands that were over $100 a share. I think on that day we're trading like something like $1.25. And the opportunity was unbelievable. So Brian, let's just go back to that market timing graph for a minute, and I'm going to wind this up. So what we were able to do, we nailed some major bottoms, we nailed some major tops. That is 2000. We got out on March the 17th, 2000, close to the top. So what we have here is a system that will generally keep us on the right side of the market. It will generally get us in close to the bottom and out close to the top. No system is perfect. People always ask me about, well, you know, you had a confirmed down and 2 weeks later it went up again. I said, sure. You know, all we do is report what we see. We don't tell the market what to do, okay? And so if it goes down and then it goes up, the losses are relatively small. You can live with those. But you cannot live with this kind of a loss and this kind of a loss. You cannot be long in a time like this. Okay, finally, we summarize this in the color guard. Brian talked about the color guard earlier today. We have the daily color guard report. We talk about market timing on our strategy of the week each Friday, presentations, and we try to keep it simple. I've had hundreds and hundreds of people come to me and say, I can time the market better than you can using your own data. And I say, that's wonderful. That's wonderful. But generally speaking, their techniques are very complicated. We even have a user group that is selling a market timing system based on our data, okay? And when they sell it, they have a disclaimer at the top that this is copyrighted material. I'm going to shut them down a little while. But they're very proud of what they've done. It's so complicated, we're trying to figure out what they're doing. We want to keep it simple. And with the color guard, we think it's as simple as we can get. You have the color guard, you can read it in the views, and we try to explain exactly what's happening. I think over the years, it's passed the test of time, and you know, it's given me a great deal of confidence in investing in the market. Now, having said all that, from 2001, from 9/11 to the re-election of George Bush, I was very antsy about the market because of the terrorism thing, okay? So I usually had a protective position of puts in my personal portfolio. Last May the 6th to be precise, the market got a sudden drop, a humongous drop, and it recovered during the day. That was the famous flash crash, okay? And it pretty well was whitewashed. That still worries me. And so we can time the market, we can have a good market, we can have Bernanke lighting a fire under the market, Because you know the market's essentially gone up ever since he started QE2. So one of the things we got to keep our eye on is a possibility of the market taking a little correction if it's indicated he's not going to continue with QE2. But nevertheless, one thing we have right now, we have an unknown factor, and that's this high-frequency trading. And there are a lot of strange things going on in the market that I'm not sure what they are, but if you read Barron's last Saturday, the gentleman that writes about trading in the markets and that sort of thing, he's suggesting that there's some unexplainable things happening in the trading. So it's just a comment I want to make that while we try to be as comfortable as we can what we're doing, okay, don't go whole hog. You got to have your protective positions in place. In other words, don't invest every last penny you have. Use a good diversified portfolio. And with that, I think I've taken up 10 minutes of your lunchtime, but I hope it was worth the price. Thank you.